There's a lot of uncertainty out there. It looks like inflation is going to soar to nearly 8% by Christmas, and it'll be chased by interest rates that together will send people's ability to pay for things further into reverse. It'll halt the jobs boom, and it could put the brakes on economic growth. Now, I know many people are preparing for a really rocky road ahead. But I don't necessarily agree with them. If the government and the Reserve Bank get their settings right, inflation will moderate next year and slowly return to within the Reserve Bank's target range. Unemployment will rise a bit, it'll hover around 4%, and real wages will start to grow, and hopefully we'll end up with that desirable soft landing. However, I'm a fan of being prepared and not ending up in a crisis, rather than ending up in a crisis and not being prepared. So once a month I catch up with leading economic commentator Pete Wargent in these monthly Big Picture podcasts where we take a look at the macro factors affecting our economy and our property markets. Now clearly you enjoy these shows as they're the most downloaded of my regular podcasts, and I'm sure today's chat is going to be useful for you as well because we're going to discuss the Reserve Bank's latest forecasts. We're going to talk about the truth about mortgage stress. We'll chat about falling business and consumer confidence, what's really happening to inflation, and why interest rates may not be raised as much as some are predicting. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Boy, has a lot been happening since I last spoke with Pete Wargent for our monthly Big Picture podcast. One of the big changes over the last month is falling consumer confidence, falling business confidence, and unfortunately that can be a bit of a self-fulfilling prophecy. So today, amongst many other topics, I'd like to have a chat with leading analyst Pete Wargent about investment cycles and how they can influence one's investment psychology. Now, while regular listeners will know Pete well, if you're new to this podcast, well, firstly, welcome, because I can see there's thousands of new listeners every month. But the reason I'm keen to discuss these big picture matters with Pete is not because of his academic credentials as a chartered accountant, chartered surveyor, or because he's got a financial planning diploma, but I enjoy these chats because of the incredible perspective Pete brings on what's happening around the world as an international investor and business person. Hi, Pete.
Thanks, Michael. It's great to be on as always. As you said, there's quite a bit happening at the moment, so looking forward to discussing.
Well, we like talking about the big picture factors that are going to affect our economy and our property markets. And in its quarterly statement on monetary policy, the Reserve Bank recently outlined some of the challenges it expects to be facing to counter the decade-high levels of inflation we're experiencing. Interestingly, recently the bank's lowered its growth forecast for our economy. It's substantially lifted its inflation forecasts, or since the last statement in May, a quarter of a year ago. It's forecast our CPI is going to reach 7.75% by the end of the year, and then it's going to start dropping closer to within its band that it's wanting, but that'll take some time. It thinks unemployment's going to fall a bit lower, and that's going to fuel wages growth, and it tips our economy is going to grow at 3.25% this year and then slow down. Now, we know the Reserve Bank hasn't had the best reputation for forecasting over the last couple of years. So what are your thoughts about these predictions?
Yeah, so inflation is the big one. It's not just an Australia problem. It's something that's happening all around the world. And I think just as the RBA predicts, headline inflation is going to rise from here probably until about the end of the year. So there's things like electricity bills and power and energy bills still to rise. And also rents are actually rising in a double-digit pace. But on the other hand, I think the fears about inflation, it's sort of accelerating and spiraling out of control in Australia, I think those have eased somewhat. Just things like the oil price is down to the lowest level since January, about $87 for a barrel now. It was up at 125 at the peak.
Well, we're seeing that at the petrol bowser. You're overseas at the moment, but petrol now is $1.50 something a litre compared to $2.20 a litre only a couple of months ago.
Yeah, and I've heard in Queensland people are paying, 50 cents less a litre than they were. There's going to be a bit of a sting in the tail there because the fuel excise cut of 22 cents a litre actually expires at the end of September. But there's other things coming, things like global freight rates. I mean, they're practically halved from where they were last year. So if you look at what consumers are expecting, even just 2 months ago, their sort of year ahead expectations were 6.7%, and then there were 6.3% in June, and now 5.9%. So I think that people are starting to get a bit more confident that actually inflation is going to fall away next year for all of those reasons and more. And yes, we're tracking a bit behind what's happening in the US with things like power prices and rent hikes still to flow through. And the economy is still a bit sort of stretched in terms of its capacity in some parts. But by next month, the Reserve Bank will have actually hiked about 225 basis points, and that's clearly starting to work as well, just to sort of bring that inflation rate down gradually over time.
One of the problems is inflation is only reported by the Australia Bureau of Statistics quarterly, and by the time we find out, it's actually looking back way back in the rear vision mirror. But they're going to change the way they're now going to present inflation figures to monthly. It'll be interesting to see if they can get enough data and make that accurate and make forecasting more timely and accurate, Pete.
Yeah, we do have a monthly inflation gauge that the Melbourne Institute has run over the years, but it's not actually quite the same. It doesn't line up exactly to the official ABS figures. Most other parts of the world in the developed economies like to have a monthly inflation gauge, and Australia's, they're releasing more detail this week on how it's going to work and when. But I think it's probably a good thing because, as we mentioned, inflation is going to peak in Australia probably in the fourth quarter of this year, but those figures don't even get reported until February 2023, which is actually a long time after the event. So I think moving to a monthly gauge probably does make sense.
Well, if you think about it, the Reserve Bank doesn't meet in January, it meets in February, and it won't know what's going on and what to do with interest rates unless we have that more timely reporting. But many observers think the Reserve Bank has been in catch-up mode to tame inflation. They say it left interest rates too low for too long. There's been now even a review into the Reserve Bank, but boy, it must have been difficult to plan ahead when we hit a pandemic that no one really knew what was going to happen. In my mind, they actually did a pretty good job of, and the government did a pretty good job of stopping us falling into recession a year or two ago.
Absolutely. Everybody's an expert in hindsight. It's easy to forget. If you went back to April or May 2020, people were talking about a global depression, not just a recession. They were talking about a potential depression. Maybe this was going to be a health crisis that will be with us for years or decades, and a totally unprecedented situation for the economy. So the Reserve Bank and the government aim to build a bridge to the other side of the COVID shutdowns. And as Governor Lowe has explained, they probably erred on the side of providing too much insurance. But if you wanted to choose a path to take in a totally unprecedented situation, you would much rather have too much insurance than not enough. And we're talking about an unemployment rate of 3.5%. Well, it wasn't so long ago people were forecasting 10%, 12% plus. So, I mean, yes, there's some pain in terms of the cost of living and inflation, but as the RBA has said, it's probably better that we have that than mass unemployment.
I fully agree with that. Now, of course, the media keeps talking about inflation and interest rates. It's the bogeyman at the moment. Last year it was COVID, and then earlier this year was the war in Ukraine and floods. It needs to find something to scare us about. So at the moment it likes inflation and rising interest rates. But for people like you and me who've been round the block a few times, it really is just another economic cycle, another property cycle, Pete.
I think this is really the benefit of the big picture podcast, especially talking to someone such as yourself who's been around for 4 or 5 decades in the real estate investment market. And I think once you've been through a few cycles, you do get a lot less fearful because you've seen a lot of this stuff before. Well, as we mentioned, certainly in the depths of the lockdowns, there was a huge amount of uncertainty. you can certainly see just in the last couple of weeks, consumers are starting to realise that maybe the world isn't ending. They're a bit less fearful now. There's definitely been some evidence of a shift in the property market just over the past week or two. You've got rents are rising, as we mentioned, auction clearance rates starting to bounce back. And I think what people are sort of looking forward to next year is that we're about to see a huge surge in immigration, probably to record highs, because shortages are always followed by gluts. And that's what's coming in terms of population growth. And even fixed rate mortgages, I mean, they had some alarming spikes initially, but they've come back now to under 5%, probably some more cuts to come. I think people are just starting to believe that maybe the terminal cash rate for this cycle, well, maybe it's not going to be quite as bad as they previously feared. And yeah, look, we're talking housing market. Nominal prices have fallen a bit, but in some cases, not that much. Definitely some declines at the top end of the market, 10 or 15%, but it's hardly the end of the world. And some markets have barely budged. I think if you look at unit prices in Brisbane, they're actually going up in many cases. And things like the cost of building a home, well, that must be up 30%. Renovations, the same. It's actually too risky for people to start new builds or renovations in many cases. So I'm sure you're seeing in Melbourne lots of competition for well-renovated homes at the moment. And as I said, rents are absolutely roaring along. So it's not just a one-speed market. There's plenty going on beneath the surface there.
Well, boy, you covered a lot of different points there. So let's unpack a couple of those. You're right. I've been through a number of cycles, and having lived through those, it's not as scary. And no two cycles are the same, but they've got some common features, and they're usually set off by economic and financial developments. But really what makes the cycle swing, Peter, is investment sentiment, whether it's fear or greed. A couple of years ago, it was really the fear of missing out, which I guess in some ways is greed. And now it's the opposite, the fear of getting in early. But you're right, it seems like people are now just realizing there is a window of opportunity, and eventually this is going to end, probably sooner than people expected. But you also made a good point. There are cycles within cycles. There isn't just one Melbourne property market or even one Brisbane property market. And so people shouldn't be as fussed about where we are in the cycle, not to try and pick the top or the bottom. The most important factor is, if you're talking property, is to get the right assets, the quality assets that are going to do well. I guess we started to talk a minute ago about the media telling us what a difficult time we're going to have. The property pessimists keep talking about mortgage stress. And I know some define mortgage stress as 30% of your income being spent on mortgages. But recently, the banks have reported their profits. They've done really well. And one after the other, the banks have been telling us that their loan books are pretty good, Pete. There's no real evidence of mortgage stress or the fact that we're going to have forced sellers.
No, so CBA and Westpac both reported this week mortgage arrears are record lows. So, of course, arrears are going to rise from here as interest rates go up, and that's a given. They're at all-time lows. And I think it would be fair to point out that we did have a period there where a lot of people went on to mortgage holidays. So maybe in some ways that actually resets expectations in the market, because if there are some sort of stressed borrowers over the next year or two, I think firstly there could easily be a shift to interest-only lending. Think back half a decade ago, there was 35% of mortgage debt was on interest only. Now it's virtually, it's only a third of that. It's virtually nothing. So a lot of people could switch to interest only if needed, or even mortgage holidays. I'm sure there won't be a rush of forced sales that people are sort of scaremongering about. Think about it. Unemployment's
not as long as they've got jobs, Pete.
That's
if they've got jobs, they're going to cut back their discretionary spending, aren't they? It's only if there's going to be high unemployment that people can't keep their mortgages payments up. But that's not likely in the near future. No,
unemployment rate at 3.5%. That's the lowest in 50 years, and it's falling. Job vacancies have been the highest they've ever been. And actually incomes in nominal terms are rising. So look, mortgage stress is a non-story at this stage. Leveraged consumers who are overstretched, well, yes, they'll cut back on discretionary spend, but a flood of defaults, no.
Now, we talked about discretionary spending a moment ago. You were just saying that the Reserve Bank's got two weapons to fight inflation. One's interest rates, and we know it's raising those, and they're still stimulatory. So we think we both agree interest rates are going to go up. But the other is its media commentary. It's trying to lower consumer confidence. It's going out there telling us about rising rates, about slowing economy, even mentioning the R-word recession a bit. It's trying to fear people a little bit. But while consumer confidence is low and business confidence is low, when you look at the bank's reporting of credit cards, it seems like we haven't really stopped or slowed down discretionary spending. We're not buying big items, but I think people have saved their money. They're feeling they've got to get out. They deserve more now. So we're spending money on ourselves at the moment, Pete.
Yes, I think it was a very unusual situation. We've had 2 years where people, firstly, they had stimulus checks, and then secondly, they couldn't travel overseas. So people, if they have money burning a hole in their pocket, especially when inflation's tearing along, they're most likely going to spend it. If you look at consumer confidence, well, it's very low at the moment. I guess people are fearful of rising interest rates, and history tells us that means that household consumption is set to crater from here. The consumer confidence tends to lead the trend in consumption, and I guess that's one of the three key ways in which inflation will start to fall again. Firstly, cooling demand. Secondly, just giving those supply chains time to fix themselves, which is happening. Things like freight rates that we mentioned and commodity prices. I think the other thing is just bringing in more migrants to tackle the skills and labour shortages, and that's starting to happen now as well.
Well, recently the Labor government did a backflip, I guess, and said it's going to keep bringing in a lot more migrants, skilled migrants, than it had suggested during the election campaign. It realises there's a shortage of them. And I've read recently that visas for temporary migrants, backpackers and students has increased, Pete.
Yes, through the COVID crisis, Australia lost more than 500,000 temporary visa holders. It was nearly 600,000, I think, at the peak. That will start to come back now. The other thing is that, well, we're getting over 10,000 student visa applications per week, and there's going to be a sort of concerted effort to fast-track visa applications. There's a backlog of about 900,000 applications, and 500,000 of those are people that are overseas wanting to come to Australia. Now, during the election campaign, the Labor Party was pretty much silent on population policy plans through the campaign, but now it looks like certainly the media leaks and the hints are that an immigration program back up to, well, a record high, 200,000 per annum. You know, if you throw in the growth in temporary visa holders as well, I mean, we could see anything up to, well, the record high population growth in Australia was about 450,000. We could be above that over the next couple of years. So that will definitely take some of the pressure off the labour market capacity constraints, which is good because that's one of the issues that's driving inflation and challenges in the economy. But it will bring a huge demand for housing, especially for rental properties. And I think if you I saw Bloomberg reported last week, places like Hong Kong, I mean, it's just dead in the water now as an international destination. I think 120,000 people left last year. So lots of competition for students, and front of the queue will be London, Canada, and Australia in particular. So yes, those bottlenecks are being fixed, and we're going to see a huge surge in immigration over the next couple of years.
And while that'll be great for our economy because education is one of the big exporters factors that we've got in our economy, and it'll be good for the inner city apartment market. Not that that really needs it because they're filled up too. It actually is going to put huge pressures on our rental markets, as you say, because these international migrants and students don't bring a home with them. And we're just not building enough new towers. And any new tower that comes out of the ground is going to cost a lot more, and it's not currently financially viable to build them. And they've got such long lead times. I can see the rental crisis continuing on for the next couple of years.
It's more or less a given. I think, as you mentioned, these things are cyclical. And at this stage in the cycle, what we're seeing is builders and developers going bust. I think in the June quarter, we had nearly 450 construction businesses went under. So it's the highest for a second quarter of the year for 7 years. So the September quarter, you can more or less guarantee there'll be at least 500 go under, because that's the time of year when it tends to happen. And as interest rates go up, you've got challenges with developers having started projects on fixed price contracts, and then obviously materials and trades costs have gone up. None of this is good for housing supply. It's not good for employment, but it's particularly bad for housing supply. It's too risky for a lot of families. They're just putting off renovations or building. I think you're absolutely right. New arrivals into Australia overwhelmingly are renters initially. And for a whole range of reasons, we're just not getting the supply through. There's a few factors that have been weighing on landlords as well. Things like, well, inability to refinance. There's changes to tenancy laws. There's changes to land tax rules in Queensland. There's a whole heap of things that are just pulling against the housing supply. So I think a rental crisis is more or less locked in now.
Well, a couple of points that you made there. I know some investors are thinking of getting out of the market. I think that's short-sighted. I don't think it's the right decision. But yes, change tenancy rules coming up in Queensland next year. The land tax, meaning that people see themselves as being double taxed if they own properties, not just in Queensland but in other states. There were significant tenancy laws changed in Victoria last year, which were in favour of the tenant, not the landlord. Western Australia's thinking of making the rules more in favour of tenants as well. That all means that some people are going to get out of the property investment business. I think the governments have forgotten that 90% of properties that are being let to those who have chosen not to buy or can't afford to buy, 90% of them are owned by ordinary mums and dads who only own one or two properties. They're not rich moguls that they should be taxing so heavily.
No. So one of the interesting things you mentioned, spend a lot of time in Europe and overseas. One of the observations I've sort of made over the years is that there are relatively few professional landlords in Australia. Now, I know some people will come to you at Metropole and they will understand things like, right, if I buy properties in different states, then I can reduce my land tax liability. But most people don't really know about this stuff. If you come to the United Kingdom, for example, sort of the mum and dad landlords aren't a big part of the market, but you get professional landlords who own hundreds of properties because they don't have the land tax challenges and they use company structures and so on. You're right, though. In Australia, 90% of investors have one or two properties. I think it's actually even more now, isn't it? Very few investors ever get to 5 or 6 properties. The kind of levels that you would want your clients at Metropole to get to achieve their retirement and financial independence. And there's a number of reasons for that, as we've talked about before. People make bad decisions or they don't plan ahead, tax planning, all of those things, and they end up selling before they really get the benefits of compounding growth.
Definitely. So, yes, there are going to be more challenges for landlords, but I'm not sure where else you'd put your money at the moment. I don't think Bitcoin's the right place to take your property funds out of and put there. Now, one of the challenges investors are having is that once their fixed loan rates are coming out to become variable, it's going to cost more. And currently, APRA have put a restriction on banks suggesting that they allow a lending buffer of 3%. Now, that made a lot of sense last year, and they were right because I believe the cash rate is going to go up in the order of 3%. So, yes, anyone who borrowed last year and earlier this year should be protected by having that sort of buffer. But I'm not sure that's appropriate anymore now that interest rates have already gone up, and maybe APRA should be bringing its buffers requirements back to where they were before we had these historically low interest rates. I know that's already happened in the United Kingdom where you're currently sitting, Pete.
Yeah, so it kind of made sense. If you think back to October 2021 and APRA introduced a 3% assessment buffer because there were a lot of people were borrowing heavily at the time. There was a lot of speculation. They just wanted to cool things down a bit. But yes, if you're right, if you look at the Bank of England, for years we've had a similar buffer, but the Bank of England has just scrapped that now and just gone back to a 1% buffer, largely because the Bank of England has already delivered most of its rate hikes for this cycle. Now, in Australia, by next month, if you look at market pricing, by September, well, the cash rate target will be 2.35%. Now, looking further ahead, the 3-year bond yield is, give or take, is about 3%. So there's absolutely no justification for assessing with a 3% buffer. It makes no sense from September onwards. Even a buffer of 2% would probably be more appropriate, 2 percentage points, I should say. These things, they tend to get negatively reported in the media, but we never had 3%, 3 percentage points buffers in the past, and we should go down to something more realistic, because you're putting a 3 percentage point buffer on a cash rate of 2.5%. Well, that's an implied cash rate target of 5.5%. We are never going to get there in this cycle. And it's worth remembering, we've got things like, we've basically got full employment. We've got rental vacancy rates at the lowest level in 20 years. Incomes are rising. We don't need a 3% buffer. It served its purpose. Time to move on.
Well, I remember in our previous chats you saw a window of opportunity for property investors. I remember you suggesting that by the end of this year, inflation's very likely to peak. Early next year, interest rates are likely to peak. And those who've got a long-term perspective are going to take advantage of the opportunities that the market's offering at the moment, because eventually people are going to realise, hey, it's not as bad. The world isn't caving in, and they should get into the market. We're already starting to notice that, as we started to say. Many home sellers are putting their properties on the market, listings are going up a bit, and most sellers are also buyers, so they're looking at upgrading. And at the moment, there's also buyers are buying. Auction clearance rates have started to go up, so they're not waiting for the property markets to fall further. But I don't think the cash rate is going to peak anywhere near as high as the market, whatever the market is. Now, we know that the Reserve Bank lowered interest rates to wartime lows, and we know that they're still stimulatory. But it's likely that at the end of this year, early next year, when it realises inflation's under control, interest rates aren't going to end up anywhere near as high with the 3 in front of it or 4 in front of it like the market thought it was going to, Pete.
Yeah, for a period there. I mean, it's worth remembering that some of those futures contracts, they're very thinly traded. So they're not really, some of the sort of pricing out at 12 and 18 months ahead. There's not many people trading those contracts, and it's not necessarily a strong opinion. But yeah, I think things went too high. They overshot. And realistically, yes, the Reserve Bank's going to hike a bit more from here, but I don't think we're going to see the sort of wild levels that, bond yields were up above 4 at one stage. I don't think we're going to see anything like that. And I think as well, I think a lot of people are just starting to understand that now. They're starting to look ahead and, as you mentioned, take a long-term view. I'm thinking back, I did a history degree in the history of economics years ago. And when you read it,
I didn't know that.
Well, yeah, it's a few years under the bridge now, but one of the things you find when you read history books, that they're always looking for, they identify turning points. And I was really interested to read in the Sydney Morning Herald this weekend. It was like, well, look, there was 60,000 people at the city to surf. There was 45,000 at the SCG for the AFL, which is one of the biggest crowds they've ever had for a football game, an AFL game in Sydney. And the general theme is that Sydney's back. And you can start to see this now in the vacancy rates. They're falling very sharply in Melbourne, falling in Sydney. You mentioned the CBD vacancy rates are back to pre-COVID levels and below. So I think people are just starting to move on. They're starting to think, right, the world's not ending. Let's get back to living. The world will be a bit different. Some people will be working in the office 2 or 3 days a week instead of 5. So there'll be more flexibility. But life is getting back to normal, and you can see that changing in the housing market sentiment too.
Sure, but the Reserve Bank's raising interest rates to slow down inflation, and at the moment they're still stimulatory, and it's got to at least get to neutral, that Goldilocks rate where it's not too high, not too low. But no one really seems to know what that is, and what it was last time round isn't the same at the moment. It's a great theory, but there's lots of moving parts to that. It's I guess going to be impacted by the level of debt. And there's a lot of talk about the level of debt Australians have taken on, but they haven't balanced the other side of the equation with the large amount of equity and just the general wealth of Australians.
Yeah, I mean, that's one of the reasons why in markets like Sydney in particular, prices of real estate, they rarely fall that far before people start looking for bargains again, because there's a phenomenal amount of intergenerational wealth in Sydney and Melbourne that's just passed down. We don't have big death duties in Australia. You generally find that the downturns they last for 12 or 18 months, and then people are back into the market. And you can actually see that in Sydney for good quality properties. Those buyers are still there just waiting. I think there's also going to be a change in January because stamp duty for first home buyers will be scrapped all the way up to 1.5 million. So the recovery is going to come from that part of the market. Yeah, look, the neutral rate, nobody really knows, probably 2.5%.
It's getting there then, isn't it? It won't be long till we're there.
The RBA will probably go a bit further to try and bring inflation back down, but I expect we'll get 50 basis points in September and maybe another hike or two and then a pause, and then we'll see what happens over Christmas.
So I guess going back to what we first started, it is just another cycle, and each downturn prepares itself for the next stage of the next upturn. I can see as property values eventually bottom and people get back into the market, I can't see a reason for very strong capital growth for the next couple of years, but that's the way it works. We actually move to the next stage of the cycle where buyers come into the market, sellers start realizing the market's improving, so more houses come on. And there's a period where property markets remain flat for a while, and then eventually certain segments of the market increase. But I also see this as a great time to get into what I like doing in medium density and small property development and manufacturing capital growth at a time when the market isn't going to be delivering as much capital growth. And there's no doubt that we are going to need more small developments of apartments and townhouses. That's the preferred style of living in Australia rather than the large the large apartment complexes, Pete.
Yes, and I think actually the market is self-correcting there a little bit. I think 6 or 7 years ago there was a huge surge in high-rise construction, but it's much more difficult to get those projects off the ground now. We don't have the foreign buyers to make up the pre-sales. So developers have shifted and they're building much more for what the market needs, but actually we're probably not building enough. That's the challenge. We've got it's just, as we said, gluts are followed by shortages are followed by gluts. Well, we had a glut of high-rise. Now we're going the other way. And I think there's going to be an undersupply of housing over the next few years. And I think that's where the opportunity will be for investors. And as you mentioned, in certain segments in particular, those middle ring suburbs in Melbourne and Sydney, there's going to be some opportunities there because the sheer weight of demand that's coming as immigration takes off again.
Well, no one's going to ring a bell when we reach the bottom, but there seems to be a search for the floor at the moment with more buyers getting into the markets, the rate of property prices falling, not as strong anymore, particularly in the two big markets, Melbourne and Sydney. So it'll be interesting to see what happens at the end of this year. I think Melbourne and Sydney probably will fall 6-8% overall, and in some segments of the market even more than that. But Brisbane, Adelaide and Perth are probably going to end the year higher than they did. So there isn't going to be the 10-15% overall falls in the Australian property market that some are suggesting, and definitely not the 30% falls. Early next year, there probably will be a bit of a levelling off, and then the market's going to take off again. This too shall pass, Pete.
Yeah, I think so. I mean, if you look at a lot of the fundamentals, things like immigration, population growth, we're finally getting incomes rising nicely in nominal terms anyway. So that there's a lot of stuff that's very positive, and certainly way more positive than we could have dared to hope for a couple of years ago. So yeah, a little bit of a challenge in terms of inflation and mortgage rates rising, but of course they couldn't stay at zero forever with the cash rate, and if we get back to 2.5% or 3%, that's not a bad thing.
Now, I often finish by saying we're living in the best country in the world, and we are very lucky at doing that. And I was recently challenged by somebody who left a comment on, actually for this podcast on iTunes, saying, Michael keeps saying we live in the best country in the world. What scale are you using? Who keeps track of all this? I think it's just something we've got to remember and be positive and grateful, because there's very few other places I'd rather be. So yes, we got challenges ahead, but gee, where else would you like to be? I know you live in England half the year, but you're coming back to Australia soon too. You got the best of both worlds, Pete.
Well, that's the idea. I try to follow the weather, but you're right. If you look at where do people really want to migrate to in the world, it is countries like Canada, Australia, United Kingdom, US. There's other parts of the world that were popular with expats, but Hong Kong has basically dropped off that list.
That's a real shame, isn't it? Hong Kong, I used to love visiting Hong Kong, and it was a lovely city and a vibrant city, a lot of great culture. But why would anyone want to go there now? You wouldn't trust it.
No, there's definitely been a change, and not least with the COVID restrictions, which make it impractical. So there's been a big population outshift away from that as an expat destination. And Australia always scores highly. Now, within reason, there's a lot of sort of middle-class families like the one I'm in. Within reason, we could live anywhere, but can't go too far wrong with southeast Queensland and and regional UK, in our opinion, anyway.
Okay, well, again, it was fun having a chat about all the things that are affecting our property markets. And sure, there's lots of discussion about what's happening in this suburb or that rent. So it's nice just every now and then to go back and looking at all the big picture factors affecting our markets. And I look forward to catching up in a month's time and doing it again. But before we finish, Pete, people obviously enjoy listening to you because these are the most downloaded podcasts. And before we came online, I was telling you how much I enjoyed one of your recent episodes. You're getting some great guests on your podcast. So where can people find out about Pete's property podcast?
Yeah, if you just look up the Pete Wargent Property Pod, you can get that on Spotify or Apple or pretty much anywhere that you get your usual podcast fix.
Well, I guess where you're listening to this podcast is where you should be looking out for Pete as well, because he has some great guests and guests that other people don't have, which I think is a great way of doing things as well. And if people want to get in contact with you with your regular blogs, where do they look for you, Pete?
Oh, I usually have a brain dump once a day at Pete Wargent Blogspot. So you can read my ramblings there. There's always something to be looked at and something to be said.
And on Twitter. Boy, are you prolific on Twitter. So if you want to have a great view of what's happening, not just in Australia, but around the world in the economy, follow Pete Wargent on Twitter. Look forward to catching up with you again in a month, Pete.
Cheers. Look forward to it. Thanks, Michael.
As you heard in my chat with Pete Wargent, we both have a more positive outlook on what's happening with our property markets. So if you're considering getting involved in property as an investor or as a home buyer, I think it's a good time to plan for the next phase of the property cycle, which is likely to come sooner rather than later. Now, I know a lot of people are asking, should I buy now? Should I wait? What if property values drop? And I know a lot of investors in particular are concerned about their cash flow. And yes, interest rates are going to go up and cash flow will be different. So it's important to plan the next phase. You can't just go off and buy any property. Firstly, because it's that stage of the cycle where some properties are going to keep falling in value and other properties are just not going to increase in value significantly. But it is a good time to formulate a plan. It is a good time to get the right advice. It's in fact more critical than ever. So why not have a chat with my team at Metropole and have a complimentary clarity consultation where you can find out about what your options are. Remember, we don't have any properties for sale, but we offer strategic advice that helps give you direction through these more challenging times, helps give you more certainty, and helps our clients get better results because our audited results show that our clients are 7.3, I was going to say 6.3, but it's actually 7.3 times more likely to own 6 or more properties, to be in the top 1% of property investors than the average investor. So go to metropole.com.au and find out about how we can help get you that direction, results and clarity. Leave us your details. So is it the right time to buy or not? I don't know. I don't know your circumstances. So rather than going to somebody who's going to make their money selling you a property or buying you a property, let's get the right advice. Remember the old Chinese proverb. It says something like, when was the best time to plant a tree 20 years ago? When's the second best time? I guess now. In reality, there's no right or wrong time to buy your new home or your next investment property. Our property markets are cycling, like we said. So what's really more important is, where are you in your phase of your investment journey or your life? Where are you financially? And are you going to be able to ride the ups and downs? And that's what we need to help you with. Metropole.com.au. We look forward to being part of the ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today's mindset message is short and sweet. It's something I read the other day and I thought I must share with you. And it was called "No is easier to do, but yes is easier to say." So let me explain to you what that was all about. No is no to one thing, but when you say yes, you end up saying no to 1,000 things. In other words, when you say no to one thing, it's a choice that breeds choices. Tomorrow you can be open to new opportunities, just as you were today. On the other hand, when you say yes to one thing, you've spent that choice. The door's shut on a whole host of alternative possibilities, and tomorrow's that much more limited because you've chosen to do something. When you say no now, you can always come back and you can say yes later. If you say yes now, it's harder to say no later. So there you have it. No is easier to do. Yes is easier to say. I hope you got some benefit from my chat today, and if you did, and you know somebody else who'd benefit, please do them a favour and tell them about the Michael Yardney podcast. You'd be doing me a favour as well in my quest to make as many people as financially literate as possible. Now, it's actually really easy. If you've got an Apple phone, there's 3 little buttons at the bottom of Apple Podcasts. Just press the 3 little dots, and there's a share button, and there's a similar share button on Spotify or all the other podcast apps as well. And of course, you can tell the world by leaving a review. Now, I'll be back again real soon, but you can catch me in between shows on social media. Just look for Michael Yardney, and I'd love you to be part of my private Facebook group where every day I leave a tip, some charts, something different that I won't leave elsewhere. Go to Facebook and look for the Property Update Facebook group. And as my way of saying thank you, if you're a new subscriber to this show, go to podcastbonus.com.au, and I've got a bundle of ebooks and reports for you. Now, I've mentioned a whole lot of things, but there'll be some links in the show notes for you, so join me on social media or get those bonuses. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?